Yes, so I want us to look on this particular question here for last sitting. That is the question for April of 2025, which is question number 3. So what are we told? What are we told as far as this question here is concerned? What are we told? The question reads that on 1st of January 2024, Pool Limited acquired 80% controlling interest in SHIP when the retained earnings of SHIP Limited amounted to 3.2 million. The acquisition consideration consisted of an immediate cash payment of shillings 12 million. And on 1st January 2024, a further cash payment of 12.1 million deferred until 1st of January 2026. So this is basically a deferred consideration. Then you're told Pool Limited had a cost of capital of 10%. No accounting entries have been made in relation to the deferred cash consideration. And then you're told Pool Limited also acquired 50% equity interest in a company which is called 𝐊𝐀𝐒 Limited and obtained joint control of 𝐊𝐀𝐒 Limited on 1st of January 2024. So the purchase consideration comprised of an immediate cash payment of 10 million on 1st January 2024. And then you're told the retained earnings of 𝐊𝐀𝐒 Limited on stood at 2.5 million on the same date. And then you're told the following are the draft financial statement of financial position of the companies is at 31st of December 2024. Yes, can someone reshare all the questions, all those past papers? Someone to reshare, Helen, or someone to reshare all the papers. We have 2 batches of past papers, the one up to August 2023 and the other one, because if you check on the one which is having all questions, I think there are some papers which are missing, especially the papers for 2022. Someone to reshare those papers. Once the shares are reshared, Raphael, make sure you have those papers with you. Sasa? Yes. So in our case, we are given the draft statement of financial position of these 3 companies, Pool, SHIP, and 𝐊𝐻. So we have the non-current asset, current asset, equity, non-current liabilities, and current liabilities. And then we have some additional information, number 1, 2, 3, and 4. What are we required to do here? We're required to calculate the goodwill on acquisition of SHIP Limited. We determine the value of investment in 𝐊𝐻, and then we're required to prepare the consolidated statement of financial position. These are very, very simple question, a very good question on group accounts. Remember what we said is that once you come across that question for group accounts, the first thing you need to do is always to come up with a group structure. To come up with a group what? To come up with a group structure. So the information about the group structure, we have it within paragraph 1 up there. I hope, Raphael, you have gotten the past papers. I hope you have gotten those past papers. They have been reshared. I hope they have been reshared. So in the first paragraph up there, we are told on 1st of January 2024, the company which is called Pool Limited acquired 80% controlling interest in a company which is called what? SHIP. So we are told this company which is called Pool Limited acquired 80% controlling interest in a company which is called SHIP Limited on which date? 1st January 2024. So automatically the parent list is what? Is a subsidiary. And then we can go back, we can go to paragraph 3. Let's go to paragraph 3. And you're told Pool Limited also acquired 50% of the equity interest in 𝐊𝐻 Limited and obtained a joint control of 𝐊𝐻 on 1st January 2024. 1st January 2024, this company here acquired 50% of the joint control on 1st January 2024 of a company which is called what? 𝐊𝐻 Limited. What basically means is that this is the parent, this is basically a subsidiary, and then this is what? Is a joint venture. That is the first thing you should do always, anytime you come across a question for group accounts. Remember you said that in preparing the group accounts, what we do, we combine similar items, those of the parents, those of the subsidiary. Like if you check on what you required in number 3, we prepare consolidated statement of financial position. We will add similar items of asset and liabilities, those of the parents, those of the subsidiary. We said we don't consolidate as an associate. We don't consolidate a joint venture. We will not consolidate the assets and liabilities of this with those of the parent. So as far as 𝐿𝐻 Limited, which is a joint venture, is concerned, we will compute something called the investment in joint venture, or basically investment in associate, and this basically what we required in part B of that question. Actually, this question is similar with the one which we did in our previous class. I hope you can remember the question which we did in our previous class. So we have that as our group structure. So having this, then we are going to use the information within paragraph 1. We are going to use the information within paragraph 1, basically in computation of what? In the computation of the goodwill. So when computing the goodwill, basically we are going to use the information we have what? We have within paragraph what? Paragraph 1, 2, and 3. So, but because we are required to compute the goodwill and also the investment in the inventor in Roman 1, Roman 2, we will use that information when answering Roman 1, Roman 2. So what I want us to do, I want us to go straight to the additional information. So in the additional information number 1, you're told at the date of acquisition, the fair value of 𝐻EP Limited, which is basically our subsidiary, 𝐻EP Limited, our subsidiary, 𝐻EP Limited, our subsidiary, 𝐻EP Limited net asset approximated their carrying amount, with an exception of some plant whose fair value was 1 million above the carrying amount. Above the carrying amount. And then we are told that at this date, the plant had a remaining economic useful life for 5 years, and then you are told no fair value adjustment was necessary in respect of 𝐿𝐻. I think this question is almost the same with the question which we did in our previous class. So what we said is that, or what you're given in note number 1 is basically the valuation of asset by who? By the subsidiary. And actually we said that process through which the subsidiary company revalues the asset on the date of acquisition, we refer to that as the fair value adjustment. In other terms, we refer to that as the fair value what? The fair value exercise. And in this case, we said that once the subsidiary company has revalued the asset on the date of acquisition, the subsidiary company do not account for that what? Revaluation of assets. As a result of that, when preparing the group account, basically we make 2 consolidation adjustments. 1, we have to determine the revaluation gain. And in this case, we say the revaluation gain exists, whereby the fair value of the asset exceed the carrying amount, or basically exceed the book value. And I hope you can see what you are told in that point, that on the date of acquisition, this company, which is S, basically revalued the asset. We are told the fair value and the carrying amount was the same, but with an exception of an item of plant. We are told the fair value of that item of plant basically exceeded the carrying amount with an amount of 1 million. But if you check our figures up there, you'll be able to see our figures are 1,000 of shillings. So we have to be consistent. We are going to work with all our figures in 1,000 of shillings. So this, therefore, is the revaluation gain. Was this revaluation gain accounted for? No. So in preparing the consolidated statement of financial position, this one we said should be added to the PPE. And number 2, this is a pre-acquisition revaluation reserve. So being a pre-acquisition revaluation reserve, we are going to use that in computing the goodwill arising on acquisition of who? Of 𝐻EP. Of what? Of 𝐻EP. Number 2, we need to compute something called the depreciation under charge. Depreciation under charge. And basically that depreciation under charge is still by this company, which is 𝐻EP. How do we compute this one? We said you need to remember the formula. We take the revaluation gain, which is basically 1,000. We divide that with the remaining useful life. The remaining useful life, as per note number 1, we are told that this plant had a remaining useful life for how many years? I hope you can see that is 5 years. 5 years. And then we said we multiply this with the proportion of time. The proportion of time, basically, we said is the time we have, or basically the years we have from the date of acquisition to the date of consolidation. How many years or how many months do we have between those 2 dates? So in our case, we know the date of acquisition is this one. This was what? 1st of April, 1st of January. Yes, 1st of January 2024. The date of consolidation is basically the date we require to prepare the group account. Can we go to the requirement? Let's go to the requirement. So in the requirement, we are required to prepare the group account on 31st of December 2024. That is the date of consolidation, So here, basically, you can see we have exactly 1 year. So in our case, we are interested with the depreciation under charge for just 1 year. So 1 year, you just multiply that with 1. So this will give us what? This will give us 200. So 200 is the depreciation under charge by who? By SHAPE. We said there are 3 items adjusted with this. One, this one should be deducted from the PPE, the group PPE, deducted from the group PPE. If we happen to compute the retained earnings, we deduct this from the retained earnings of a SHAPE. But remember, you said moving forward, we will not be computing the group retained earnings because we said that computation of that item is quite demanding. And actually, we said even in an exam setup, you can't compute this. And then number 2, this 200, which is a depreciation under charge by this, in case we were preparing the consolidated statement of profit or loss, which we are not preparing, this one we added to the group cost of sales, So the key adjustment is that this one will be deducted from the PPE. Will be deducted from what? The PPE. That basically what is important for you to remember. Now, having said, and basically, if you have been very keen, you must have noted that this is an adjustment you have come across in the 3 questions we have done so far. The first question we did for Kuja Twende, we came across this. The other question we did in our previous class, we came across this. This question, we have been given information about the revaluation of asset by who? The subsidiary. That's why I say some of these consolidation adjustments, by now, you should be in a position to know how to treat them. Because this is something you come across in all questions for group account. That the date the subsidiary company was acquired, it revalued the asset. How do we deal with that? So we are done with that point. So I want us to move to point number 2. And basically you're told pool. Pool, remember, is a parent. Pool limited measures the goodwill and the non-controlling interest using the fair value method. So if you're given that, the fair value method, it basically means that when computing the goodwill, which method are we supposed to use? The full goodwill method. The full goodwill method. And you're told the fair value of the non-controlling interest in SHAPE was 57 or 5.7 million at the date of acquisition. That one, we will use it in answering part A, whereby we are required to compute the goodwill on acquisition of who? Of SHAPE. Number 3, we are told during the year which ended 31st of December 2024, SHAPE Limited, this one, sold some goods now to the parent, that is pool, for 4.5 million. Even before you move to the other point, what we are given there is basically what we refer as the intra-group trading. Intra-group trading. And basically this intra-group trading is by this company. This one is by SHAPE. By SHAPE Limited. And basically that we are told was 4.5. So this 4.5, basically number 1, this one will be deducted from the group revenue. That is basically what we know. We deduct this from the group revenue. We also deduct this from the group cost of sales. That basically is the adjustment which is required for sales between who? Between the parent and the subsidiary. Between the subsidiary and who? And the parent. And then you're told at a markup of 25%. And then we are told that, is this question just the same with the other one which we did? I feel the questions are almost the same. I feel the 2 questions are almost the same. If you have noted that they are almost the same. And then you are told, no, this one is actually similar to a question I did in AFR. Yes, in AFR, actually the 2 questions are the same. with another question I did in 𝐊𝐿. Okay. So then we are told that the markup was 25%, and then we are told a third of these goods were still held by pool on 31st of December 2024, and the balance payable was still outstanding. So in that case, we have two adjustments there. One, we need to compute the amount of unleased profit, and number two, we need to compute the amount of intercompany debt. I think first of all, let's compute the amount of unrealized profit. Unrealized profit on inventory. Remember, in this case, we said we compute unrealized profit in case some of the goods which were sold by shape to pool, some of the goods were not yet sold to third parties. So therefore, we said the unrealized profit here is by the selling company. This unrealized profit will be by shape, the subsidiary. So how do we compute this one? We said we take the unsold goods times the gross profit margin. So the unsold goods will be equal to the goods which shape sold to pool. And I hope you can be able to remember the value for those goods, which was 45. And then in this case, we are told the goods which were not yet sold, they were equal to what? The goods not yet sold. The goods not yet sold, we are told they were what? They were a third. I hope you can be able to see that. The goods not yet sold, they were a third. Is that what you're getting? Is that what you're told in that point? Talk to Mwalimu here. Is that what you're told? You're told they were a third. So then we need to multiply that with the gross profit margin. Are we given the gross profit margin? No. But in our case, we are given the gross profit markup. The gross profit markup, is basically 25%. 25%, remember, is the same with a quarter. So what would be the gross profit margin here? What would be the gross profit margin? Gross profit margin, I'm told it will be 1/5. Yes, it should be a quarter, and then to the denominator we add the numerator. So it will be 1/5. So we multiply that with 1/5. And this will give us what? This will give us what? This will give us 1,500 times this one, which will give us 500. So this 500, which is basically the amount of an realized profit, this one, number one, should be deducted from the group inventory. Number two, it should be deducted from the retained earnings of this. In case we are preparing the consolidated statement of profit or loss, we should add it. We should add it to the group cost of sales. But the key consolidation adjustment is this. We will deduct it from the group inventory. We will deduct that from the group what? Inventory. Because remember, you said no need of computing the group retained earnings. We are not required to prepare the consolidated statement of profit or loss. So the key consolidation adjustment is to less that from the group inventory. So we are done with that. Yes. So I think I've corrected that. The figure should be 300, not 500. Okay. Thank you, Sat. Thank you for that, Juliet and Helen. So let's move to the same point we are told, and the balance was still outstanding. The balance was still outstanding. What is the balance? The balance basically is equal to the value of the goods now which were sold. The goods which were sold by this company to this. Those goods had a value of 45. So this company had not paid for those goods. So if this company had not paid for those goods, basically that gives rise to something called the intercompany debt. So the intercompany debt, we are not given that, but automatically it should be equal to the value of the goods, which was sold by this to this, which had a value of 45. So this being the amount of intercompany debt, this one will be deducted from the group trade receivables and the group trade payables. That's basically where we start. From the group receivables, from the group what? Payables. The group receivables and the group what? Payables. So basically we are done with that. So let's move to the other point. We move to the other point. And basically that is point number 5, where we are told an impairment review performed at the end of the current year revealed that the goodwill arising from acquisition of SHIP had been impaired to an extent of 10%, and then you're told that the interest in 𝐬𝐬𝐬 Limited was unimpaired. So basically, we're going to use that information in answering what is required in Part A. I hope you can see in Part A of that question, we are required to compute the goodwill arising on acquisition. And basically, that is what now I want us to do. We compute, or basically we answer Part A by computing the goodwill on acquisition of our parent company, the subsidiary, that is SHIP. Remember, as per the information which we have in note number 2, we are using the full goodwill method. 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 Okay. So let's start with the Part A, whereby we are required to compute the goodwill on acquisition of SHIP. And in this case, I've said that we are going to compute that goodwill using which method? The full goodwill method. The full goodwill method. So in this case, we need to have 2 columns here. We need to have 2 columns here. 2 columns like that. So under the full goodwill method, we always start with the purchase consideration, which was paid by the parent company. Purchase consideration paid by the parent company. Now, the purchase consideration paid by the parent company, that information, we have it within paragraph 1. We have it within paragraph 1. And I hope also we can be able to recall the purchase consideration comprises of cash consideration and the deferred consideration. Let's go back to paragraph 1. On 1st of January 2024, Pool Limited acquired 80% controlling interest in SHIP when the retained earnings of SHIP amounted to 3.2 million. The acquisition consideration consisted of an immediate cash payment of 12 million. So there was a cash payment. Remember, I said when computing the goodwill, cash consideration, this consideration paid in cash do not have any special treatment. So this one, we use it the way it is. So which is an amount of 12 million. Remember, all our figures are in thousands of shillings. And then from there, we are told on 1st of January 2024, and a further cash payment of 12.1 million deferred until 1st January 2026. So that is basically what we find is the deferred consideration. The deferred consideration. And actually, we are told the acquisition, the date of acquisition, the DOA is 1st January 2024. And then that consideration has been deferred. It will be paid on 1st of January 2026. That is when the deferred consideration will be paid. So how many years do we have here between those 2 dates? How many years do we have between those 2 dates? Do we have 1 year? Do we have 2 years? How many years do we have between those 2 dates? How many years do we have between those 2 dates? That should not take us to 2 seconds, should not take us even 2 seconds. Those are 2 years. Those are 2 years. So the deferred consideration will be paid on this date. How much? 12.1 million. So remember, you said such a consideration, which is a deferred, we said we should get its present value. We should get the present value for that. So therefore, what we need to do is to discount that to its present value. I will take 12,100. I'll multiply that with the present value interest factor. And basically, we said we discount this using the parent company cost of capital. That's why in the same point, in the same paragraph 1, the last sentence, we are told, Pool Limited, that is the parent company, cost of capital was 10%. So we discount this using the parent company cost of capital 10%, and this basically for 2 years. We get the present value interest factor at the rate of 10% for 2 years. For 2 years, 12,100 times present value interest factor at the rate of 12% for 2 years. So how do we get this value here? We use this particular formula there. 1 plus R raised to power negative n. So this one will be equal to 1.1. Our R is 10% raised to power negative 2. And then basically we multiply that with what? We multiply that with 12,100. 12,100. So that basically will give us a value of how much? That will give us a value of how much? 1.1, which is basically raised to power negative 2 times 12,100. And that will give us exactly an amount of 10,000. So that is basically how we deal with the deferred what? Consideration. Then to this, because we are using the full Gooding method, we add the fair value or the NCH fair value, LCI at fair value. So NCH fair value, remember this one is given within note 2. Note number two, we have the NCI at fair value. In the last sentence of note 2, the fair value of non-controlling interest in shape was 5.7. So we need to add all this. So this will give us 700. This 27. Uh, 700. And then to this, we need to proceed. And basically, we less the fair value of net assets acquired. Fair value of net asset acquired. Remember, you say that this is one of the tricky area where majority of the students get it wrong. So to compute this, how do we compute the fair value of Shape Limited net asset on the date of acquisition? We say take its ordinary share capital plus the pre-acquisition reserves. That's what you just need to remember. So what we do, we go to the balance sheet of this company, specifically at the equity. So let's go to the statement of financial position of Shape at the equity. And the first item we consider here is the ordinary share capital. The ordinary share capital of Shape. And I hope you can see that, which is an amount of 20,000. So below that, what we have is the share premium. Premium. And in this case, I said, in case you're given the share premium in the statement of financial position of the subsidiary, if the question is cited, then in this case, we treat that as what? As pre-acquisition. As pre-what? A pre-acquisition, if the question is cited. So I hope you can see in our case, this particular question is cited regarding that share premium. So we treat it as a pre, which is 2,000. Still below where we have the equity, what do we have there? We have the retained earnings. So, but basically that retained earnings which are given here, that is the retained earnings at the end. What we are interested with is the retained earnings on the date of acquisition. The retained earnings on the date of acquisition. And I think we are given this within paragraph 1. Can we go back to paragraph 1? We're told on 1st January 2024, who Limited acquired 80% controlling interest in Shape when the retained earnings of Shape was 3.2. That is basically what we're interested with. The retained earnings on the date of acquisition, 3.2. And then if we go back to where we have the equity, you can see we only have those 3 items: share capital, share premium, retained earnings. But I've said never make a mistake of taking the retained earnings which are given in the statement of financial position. That is the retained earnings at the end. That is not our interest. Our interest is the retained earnings of this company on the date of acquisition, which is known as pre-acquisition retained earnings. There is something I said you should also consider here, and that is basically any revaluation gain which occurred on the date of acquisition. Did this company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? I hope you can remember this. This company revalued the asset on the date of acquisition, and there was a revaluation gain of 1,000. So that one we also included here, and that's why we said this one is a pre-acquisition revaluation reserve. We are going to use it here in the computation of what? In the computation of goodies. And I think in our case, we are basically done. So what we need to do is we get this total. This will be 22, 25, 200. 25,200, 26,200, 26,200. And basically, then here, remember we are computing the goodwill using the full goodwill method. So under the full goodwill method, we take 100% of that. So 100% of that will be 26,200. So we left that from the figure we have up there, and basically we get the goodwill. We get the goodwill on acquisition. The goodwill on acquisition here will be 1,500. Will be 1,500. Then you need to check, was this goodwill impaired or not? It was impaired as per note number 4. We are told in note number 4, the impairment review performed on 31st of December 2024 revealed that the goodwill arising from acquisition of 𝐊𝐈𝐒 Limited had been impaired by 10%. So this goodwill was impaired with 10%. So what we need to do, remember in this case we said goodwill being impaired, it basically means that the goodwill has lost some value. This goodwill had lost a value of 10%. 10% of the value of the goodwill, which is 150. So what will be the value for the goodwill at the end of the year? And that is basically what we are required. It will be 1350. So that is the value of goodwill. The value of goodwill at the end of the year, that is 31st of December 2024. And that's what was required in Roman 1 of that question. By doing that, the marks allocated here were 6. So automatically those are the items which were marked here. These are the items marked, including that. So by doing that, you can see the kind of the marks which were given here. 6 marks, 6 marks. So having that then, and I hope you can see this question. This question is almost the same with the other one which we did. Then from there, we need to proceed. And basically, we answer Roman 2. Roman 2 of the question, part B of the question. What are we required to do? We're required to compute the value of interest, the value of interest in 𝐷𝐿𝐻 Limited. In 𝐷𝐿𝐻 Limited, also at the end of the year, as at 31st of December 2024. So how do we compute this one? How do we compute this? Quite simple, provided you can be able to recall the format. So here we take the cost of investment. The cost of investment, basically that's what we said. To this we add the group share. The group share of, remember these are joint venture. Joint venture. Post-acquisition retained what? Earnings. Retained earnings. And then to this, we less any impairment loss. Any impairment loss. Remember, in this case, we said that if, for example, this particular joint venture has been making losses, or even maybe its sales has been declining over time, you can be told the parent company or the value of investment made by, or the investment made by the parent company that as joint venture had lost some value. So you'll be given that information. But if you check on this particular question, specifically note number 4, the last sentence, we are told the investment in 𝐷𝐿𝐻 Limited was unimpaired. So this investment in 𝐷𝐿𝐻 had not lost any value. So in that case, it means that we don't have any impairment loss. We don't have any impairment loss. So what we need to have is basically these two values. This one is already given. How much purchase consideration was paid by the parent company in acquiring 50% of the share in 𝐷𝐿𝐻? That information, do we have it within paragraph 1? Yes, within paragraph, not paragraph 1, actually paragraph 3. We are told 𝐻 Limited acquired 50% equity interest in 𝐷𝐿𝐻 and obtained a joint control over 𝐷𝐿𝐻 Limited on 1st January 2024. The purchase consideration comprised of an immediate cash payment of 10 million. But equally, if that information was not given here, mostly this one will be given in the statement of financial position of the parent. If you go to the statement of financial position of the parent where we have non-current assets, you should be able to see the purchase consideration. Can you see that amount in the statement of financial position of pool under the non-current asset? You should be able to see we are given PPE. Below that, we have investment in shape and investment in jewelry. So the investment in shape is basically this cash consideration. The investment in jewelry is this cash consideration of what? Of 10. So having that then, we need basically to proceed and we compute this. What is the group share of the joint venture post-acquisition retained earnings? So for us to be able to compute this one, so what we do, we take the retained earnings of this company, that is Jolte, at the end of the current year, which is basically in the balance sheet of this company. Can we go to the balance sheet of Jolte? In the statement of financial position of Jolte, under equity, can you see the retained earnings of Jolte? The retained earnings of Jolte here is 38. That is now the retained earnings of this company at the end of the current year. So that retained earnings of 38, this one comprises of the pre-acquisition retained earnings and the post-acquisition retained earnings. So what we need to do here, or to this figure, is we less the pre-acquisition. We less the pre-acquisition because in our case we're interested with post. The pre-acquisition is the retained earnings of Jolte at the date it was acquired. Just like what you have done for the subsidiary. Its retained earnings at the date of acquisition is the pre. So if we go back to paragraph 3, can you go back to paragraph 3 of this question? We are told Pool Limited also acquired 50% of the equity interest in Jolte, obtaining joint control on 1st January 2024. And then you are told the purchase consideration was 10 million on 1st January 2024. The retained earnings of Jolte stood at 2.5 million on that date. So that 2.5 is the retained earnings of this company on the date it was acquired. That is the pre-acquisition. So, and we are saying this comprises of the post, the pre and post. So what we need to do to this is we less the pre. The pre is 25. So what we shall be left with is the post. And then we get the parent company share of that. The parent company share of that will be 50%. So we take this minus this, which basically will give us 13. And then we get what? 50% of that, which will give us what? Which will basically give us 650. So we add these two figures. Remember, we don't have any impairment loss, which will give us then 650. So that basically what is required as far as Roman 2 of that question is concerned, 2 marks for this and for that. Yes. So next, we move to part C. Part C of the question, what are we required to do? We are required to prepare the consolidated statement of financial position. So part C, consolidated statement of financial position as at 31st of December 2024. 31st of December 2024. So basically what we need to ask ourselves here is, how do we prepare this one? How are we going to prepare this? Now this one will basically be prepared by doing what? By combining similar items of assets and liabilities, those of pool and those of shape. In this case, this is a joint venture. Do we consolidate a joint venture? No, we don't consolidate a joint venture. So instead, what we include here, as far as the joint venture is concerned, or even as far as the associate is concerned, is what we have computed here. This investment in Yes, Mourinho is back. I don't know what is happening with my Zoom nowadays. Okay, I hope my sound now is back. Is my sound back now? Is my sound back? Yes, it should be back. It should be back. Okay. So let's just continue. So basically what I was saying is that how do we prepare this one? To prepare the consolidated statement of financial position, we will combine similar items of asset and liabilities, those of pool, those of shape. Are we going to do the same for Jolty? No. These are a joint venture. We don't consolidate a joint venture or even an associate. So what we will include here, as far as this company is concerned, is this what you have computed, this value which you have computed here. Investment in associate, or sorry, investment in joint venture, and basically that one will be recognized here as a non-current asset. Non-current what? Asset. So let's move, and basically we prepare this one. We just need to have a single column here, and basically our figures will be in thousands of shillings. So we will start with the non-current assets. Non-current assets. So for the non-current assets, we will start with the PPE, property, plant, and equipment. So in this case, I've said we will only combine assets and liabilities, those of pool, those of ship. So the PP of the parent, that is pool, that is 6,400, plus those of ship, which is 18,500. So in this case, I've said we don't consolidate a joint venture. So, but if we're in this case, so meaning that we are not including the PP of the Jolty. So in this case, then we have some consolidation adjustment to the PP in relation to this working two. So there was a revaluation gain of 10,000, which was not accounted for. We added to the PP. And also we have this depreciation other charge of 200. We less it from the PP. So two adjustments. We add 1,000, and then we less the depreciation other charge. No any other consolidation adjustment. No any other consolidation adjustment. We get the final figure. That is 6,400 plus 18,500 plus 1,000 minus 200, which will give us 55,700. Okay. Then below that, what do we have? Below that, we have the investment in shape, investment in jewelry. Do we include that here? No. So in relation to the investment in shape, this one, what we include here is basically the goodwill arising from acquisition. The goodwill arising from acquisition of who? Of shape. The goodwill arising on acquisition of shape limited, which is this value here. The goodwill at the end of the year, 1350. In relation to the investment in Jolty, what we include here is not the amount of 10,000, but basically what we have included here. And we include that here as an investment in what? As an investment in Jolty Limited. Jolty Limited, which is basically this value here, 10,650. Like that, 10,650. So anything else to be included here? Nothing else. So we need to proceed, and basically we record the current assets. We record the current assets. So for the current assets, we start with the inventory. We start with the inventory. We will take the inventory of the parent, which is basically 50,000, the inventory of pool, plus that of shape, which is basically 20,000. Remember, we are not consolidating. We are not consolidating. We are not consolidating those of. We are not consolidating those of Jolty. We are not consolidating those of Jolty. Those of Jolty. Now better. Continue. Yes. So basically, what I've said is that for the inventory, we are combining the inventory of the parent, and that is pool, and that of shape. We are not combining, or we are not considering the inventory of Jolty. And then in this case, remember, we have some consolidation adjustment affecting, or actually we have a consolidation adjustment affecting inventory. And that is basically what? That is, okay, I've taken the wrong figures. Yes, I've taken the wrong figures. It should be 21. Yes, it should be 21,400 plus 13,000. So to this, we need to less what? The amount of unreleased profit, this one, 300. So give me the final value there. The final value will be what? The final value I'm told to be 34,100. And then below that, what do we have below the inventory? The other item of current assets, which we have there is receivables. We take the trade receivables, those of the parent, which is 18,500, plus those of ship, that is 11,400, and then to this we less the amount of intercompany debt. The amount of intercompany debt. What are you saying, Helen? Investment in George is 10,000. Why are you getting 10,000? Are you getting 10,000, Helen? So the investment in George is what you have computed up here. That is basically what we're including here. That is what we are recognizing down there. What you have computed there. Just like what we did in the other question. Or why are you getting 10,000? It should be 10,650. Whatever you have up here. So then from there, I've said to this, we less the amount of intercompany debt. Remember, you have this amount of intercompany debt 45. So we less it from this value. So give me the final values here. What will be the group trade receivables? The group trade receivables, which is 25,400. 25,400. And then to this we have, or to this we add the cash and the cash equivalent. So we do the same cash and cash equivalent. We take that of the parent, that is pool, plus that of ship, which is 81. Do we have any adjustment to this? No, because we don't have cash in transit. So we get the total here, which will be 2,800. So basically we are done with the assets. Then from there, what we need to do is we proceed and we record what? We record equity and non-current liabilities. Remember, you say that whenever you're doing this particular question for group account, never waste your time even trying to get the totals here. So whatever will be marked are these entries here. So these are the figures which give you the marks. Sasa, yes, no need of even wasting your time to come and you get the total what? The total asset here. The total asset. This one will not be marked. So let's move and record the equity. We proceed and record the equity. So the first item of equity is the ordinary share capital. Ordinary share capital. In this case, we said here, we only include the share capital of the parent company. And in this case, we say the share capital of the parent company remain the same unless there was purchase consideration which was paid which was paid through share exchange. So do we have a share exchange consideration here? No. The parent company in acquisition of this subsidiary paid a cash consideration and a deferred consideration. So we don't have any share exchange consideration. So therefore the share capital of the parent company remain the same. It will remain the same as an amount of 50,000. So then below that, what do we have? We have the share premium. And equally in this case, for the share premium, we said we include that of the parent company only. So which is basically how much? 5,000. Below that, what do we have? We have the retained earnings. And actually, in this case, we said that moving forward, this is basically an item we will not be computing. So because we said even in an exam setup, you will not compute the retained earnings. These are questions basically will be in a position to get all the marks without even computing what? Without even computing that retained earnings. We said moving forward, that is an item we will not be computing. So we should get the total equity here, the total equity, and then equally there is something else which is called the non-controlling interest. The non-controlling interest, that is NCI, and equally we said this one. We also do what? We can also ignore that. Those are the two items we say. Don't bother yourself computing them. So we proceed and finally we record the liabilities. We will start with the non-current liabilities. Non-current liabilities, we have long-term borrowing. So the long-term borrowing, this is an item of liability. We combine that of the parent and that of the subsidiary. And this one do not have any adjustment. So we take 18,000 plus what? Plus 85. No consolidation adjustment here. This basically gives us 26,500. Now there is something else which we have to include here. This is what? It is this deferred consideration. You see this deferred consideration, this is basically a consideration which is payable by the parent company in the future. So this to the parent company is what? Is a non-current liability. A non-current liability, which basically will be payable in 2 years' time from the date of acquisition. So do we include that amount here at 10,000? No. What basically we do, we take 10,000, and because this is like this is a liability is something like a loan. So a loan or even debentures, we know they attract interest. So what we do is we have to compute the interest on this. So the interest is always computed using this rate. And I think this rate was what? Was it 10% or 12%? Was this rate 10% or 12%? This rate was what? Was it 10 or 12? Okay, it was 10. It was 10 because I've noted here as 12. So we compute interest on this because I'm saying these like around these are like debentures. So that interest basically increases the value for this. So to this we add interest of 10%. Or in other terms, we take 110% of this. 110% will include the interest of 10%. So, and that interest, okay, first of all, we compute that, which will be 11. So that interest, which now we are saying will be 10% of this value here, which is basically 1,000. If we were preparing the consolidated statement of profit or loss, this one we recognize it as part of our finance cost. This one should be added to the finance cost, that interest. Sasa, if we were preparing the consolidated statement of profit or loss, and then we add it to this. So it means that the deferred consideration at the end of the day will be what? Will be 11,000. So we are basically done with that. So finally, what we need to do is basically proceed, and we do what? We record the current liabilities. So for the current liabilities, we have two. We have the trade payables. The trade payables, we combine that of the parent, which is 16,300, plus that of the subsidiary, that is shape 95, and then to this we less the amount of intercompany debt. This one 45, and that will give us what? That will give us 21,300. And then finally, what do we have? We have current tax. Remember, you said anytime you come across a component for tax, in this question for group account, you come across a component for tax. In this question for group account, this is always a free mark. Be it in the income statement, be it in the statement of financial position, is always a free mark. We have 85 plus what? Plus 49. No adjustment here. So we get an amount of 13,400. And then we get what? We get the total equity and what? total equity and liabilities. Equally, no need of adding fund. What will be marked by the end of the day are these entries here. These entries here, those are the entries which will be marked, which will be marked there. And basically, by doing that, you can see the marks allocated here were 12 marks, 12 marks. So this question was basically a very good question here, a very simple one on the group accounts.